Here's why ultra-rich investors don't really care about recessions. The reality is that they do not invest their money the way that the average investor does. And you have to really break it down into three different categories. Category 3 is the one that we're talking about today. But first, category 1, that's self-managed assets. A lot of ultra-wealthy investors in today's market still go into the public market, buy stocks, buy ETF, buy fixed income securities, and self-manage their assets. The second segment of ultra-wealthy investors are working with your typical investment advisors. These are big household names that you've definitely heard of that tend to carry a lot of clout with them, but ultimately what they're doing is just creating a traditional portfolio that's some combination of publicly traded equity with sleeves of fixed income alongside it. This is your typical 60-40 portfolio or 80-20 portfolio. So it's pretty similar to what self-managed investors are doing, except they have an advisor doing it for them, but using the same asset classes. The downside of either of these two strategies is you're only using one or two asset classes for investment. So should one of those asset classes go down, like the S&P or the public market, which we know that it does, you're gonna be generating negative returns for the year. The second part is, if you're using two asset classes, stocks and fixed income, like we saw in 2022, they can both go down at the same time. The thinking used to be that stocks and bonds had a negative correlation. Stocks would go up, bonds down, maybe generate some yield. Stocks would go down, bonds would do well. We saw in 2022 that both of those asset classes were down double digits through the same year. So that type of portfolio is just not as effective as it used to be. But unfortunately, most ultra wealthy and wealthy investors, and certainly average investors, are still using those strategies. The third category of ultra rich investors are those that are working with either family offices or multifamily offices. And the difference in their asset allocation is that they're building a multi-asset class portfolio that reduces correlation across assets to weather all different types of market cycles, have less drawdown in negative years, less volatility, but ultimately still offer a better return over time. We've all seen the major endowment funds like Yale and Harvard and what their portfolios look like, and there's very little in publicly traded equity and a fairly small amount in fixed income. Instead, what those types of funds are invested in is private equity, private credit, multi-strategy hedge funds, private infrastructure, various options and derivative strategy, of course, venture capital, and a couple others. There's been a fundamental shift in the high net worth investment advisory landscape, where now family offices and multifamily offices that manage assets for these ultra high net worth investors have access to those same funds from the same leading managers that these endowments and pension plans have been using for decades. So by building these multi-asset class portfolio that weather various economic cycles, offer better returns over time, less volatility, and more ability to sleep at night, is why these ultra net worth and very wealthy investors don't really care about recessions.